Hello, folks. It's a fine day here in Southern California. I hope you're having a good day wherever you're at here on planet Earth. This is another weekly edition of the Satori Traders Precious Metals News, and I appreciate you spending some time with me today. On the cover this week, we have Getchell Gold, and they are a junior miner, fairly new company. They just started in 2020. They acquired two properties, and one of them, the most advanced of the properties, had some positive drill results this week. And obviously, actually, it was January 27 was the press release, and obviously investors liked what they saw. And we'll take a quick peek at those drill results here in a minute. Also on the cover, no surprise, the CME raised silver margins Monday morning by 18%. And this is a standard tactic. They do this every time the metals get carried away to the upside. They increase margins. That causes traders deleverage to reduce their exposure to the market, and that of course causes the price to fall. And so anyway, we need to just be aware that that's a standard tactic that gets applied whenever the metals get carried away. Let's continue talking about Getchell Gold. If we look at the drill results, this is the press release from the company, and it's interesting information. There's some tables and charts in there. The quick rule of thumb, I love rules of thumb because there's so much information these days, we have to be able to assess it fairly quickly. And so I learned by listening to Dr. Quentin Henney, I learned this rule of 100 when you're looking at drill results. And so we got this is the results of two drill holes. They did a 6-hole program in 2020. They've got the results of, actually this is the first three holes. Drill hole number one we had a technical failure. Basically the drill bit got stuck. And that's one of the reasons that mining is such a high-risk endeavor. You know, all of the money spent on drill hole number one was essentially lost. But anyway, we have two positive results here, and we're talking about the rule of 100. And so what we see here in this table, we've got an interval of 21.9 meters at 6.2 grams per ton of gold. And so if we multiply 21.9 times 6.2, we get 120 something. The key is that it's over 100. And according to Quentin, that thumb rule of 100, when you're looking at assay results, that's you might start getting excited when you see something over 100. And so here, this is the same hole, a different interval. And so think about this. This drill hole was 278 meters deep. And so we're getting insight into that 278 meter long core that they pulled out of the ground. And so here's another section of that drill hole where we had 43.5 meters at 1.9. And so again, 43 times 2, that's 86. And so not quite 100, but pretty close. So anyway, two intervals of about 100 in one drill hole. Let's look at the other one. This is the drill hole number 3. And so here we've got 21.1 times 4.3 is 84, 85, something like that. Here's another interval at 49 at 2 grams per ton, and so 98. And so again, two intervals in this drill hole that pretty well satisfy the 100 thumb rule, and certainly the cumulative. So, you know, we've got two intervals of about 100. So that drill hole is 200. So anyway, those are good drill results. Let's see. So that's the press release. Ahead of the herd they did a high quality, took some time pointing out the value proposition in Getchell Gold. This is Bob Moriarty thing. He likes Getchell, and this is him explaining why. I've included those links. I've included those links on the, there it is, that's why I wasn't finding it, on the resource page of the newsletter. And so get the PDF copy and you'll have those links. I want to talk about behavior, price behavior. So one of the things when we look at a price chart, and it doesn't matter what the vehicle is, we want to be aware of changes in behavior. And so I would suggest here that the corn futures and the monthly time frame, they're giving us an excellent example of a change in behavior. So we see here we had 5 years of essentially it's a range trade. So I've labeled it as zero inflation for those 5 years. But now something else is going on. Now, maybe that's inflation, maybe it's not. There could be a supply issue going on in the corn markets that would explain that price movement. And it doesn't really matter at this point. All we need to know as analysts is that behavior has changed. And as traders and investors, when behavior changes, we might want to think about changing our trading strategies and our investment plans in accordance with the current market behavior. That's just, I wanted to show that chart of corn to talk about a change in behavior. And then here's another chart where we see an obvious change of behavior that start of February of 2020. And of course, this is one of the ways of measuring money supply, the supply of the US dollar. Clearly, we had a change of behavior in early 2020, and we might have a conversation about whether there's a correlation between that change of behavior and that change of behavior. And so if we continue looking at some other commodities for signs of inflation, because, that's kind of what we're thinking might be going on. When we see a chart of the money supply looks like that, we might be thinking about inflation. And so here's the wheat futures in the monthly time frame again. And a couple of things interesting in this chart to me. So we clearly have a downtrend. We have this shift downtrending pitchfork. And so price for a number of years was following this downtrend. And then obvious in hindsight, wasn't obvious at the time. Here back in July of 2016, behavior changed. That's a change in behavior right there. This downtrend became an uptrend. And of course, again, it's obvious in hindsight. The second change of behavior is when price managed to push above the upper median line of this downtrending red pitchfork. It's a sign that price is now in an uptrend. The cost of wheat is now in an uptrend. And that is a change in behavior. And so the timing doesn't match exactly because that's October of 19, and so that doesn't line up with February. That's February of 20. This is October of 19, so it doesn't line up there. And certainly 2016, that doesn't make sense for current printing. I did a little bit of research on, how do we explain this change in 2016, and I was kind of amused at a quick research. It looks like there was a disconnect between the paper wheat futures markets and price of real wheat. And obviously the resolution of that challenge resulted in a uptrend, a multi-year uptrend. And so I would point out, coincidentally, that what we have going on in the precious metals markets is a disconnect very similar to this, where the paper price of a commodity has been pushed down unnaturally. That's my opinion. And when that outside influence is changed, I suspect that the regulators stepped in and there was some fundamental change in the futures markets at that point, and the underlying market pressures were able to exert themselves, and that's why we see this uptrend. But that's just a good old boy from Texas throwing spaghetti against the wall to see what sticks. Inflation is in the wind, folks. Let me put it that way. So here we have the daily chart of gold. Obviously, the sellers of paper gold were able to push price decisively lower last week. Price rebounded immediately and is back challenging 1,800. Actually, this really was just another test of 1,800. And now price is back challenging this 1820 level, which is a support resistance level for several years here. So gold is actually looking just fine here. Obviously, the real challenge here is to break through the top of this multi-month downtrending channel. Here's the cost of gold in the papers market. It's going to cost you, what's that, about $1,814 for an ounce of paper gold. I don't know what you do with an ounce of paper gold. It's worthless, but cost you about $1,814. Now, if you wanted real gold that you could hold in your hand, that's going to cost you about, looks like it's 1928. So if I got enough, I've set aside enough cash to buy 20 ounces. Of course, we're talking about $40,000. I can buy them at $19.28 an ounce. For onesie twosie, I can pay $19.38. So I submit that that's the real price of gold. It's what it costs to get the physical metal delivered to your front door. $19.38 an ounce in gold. Silver, a couple of things about silver. So first of all, as I've remarked before, I find the fact that silver is maintaining well above its 200-day moving average, I find that very bullish. And especially in light of the slapdowns that the sellers of paper silver have attempted, as well as an 18% increase in the margins on silver, and still silver is maintaining itself well above the 200-day moving average. And so I find that quite bullish. And so here we are looking at the paper price of silver, and it is $26.90, looks like right now. And here we have the real cost of silver, and my preference always for certainly the first investment into physical silver is junk silver, 90% silver coin. And here we see that the cost of a $100 face bag is going to cost us $28.70. That works out to just over $40 an ounce. APMEX pays shipping on silver at this price. So $40 an ounce, that'll get you silver delivered to your front door. Same as in gold, they don't actually have this metal in stock. So they're expecting to have metal on the 15th, and they'll ship it to you then. But they'll be glad to take your money today, of course. These are the mining stocks, the ETF, GDXJ, the junior ETF. Bullish action last week, although we had a push down in the price action. Didn't have to go all the way back down to this, I'm calling it a double low at this point, double bottom at this point. Didn't have to go all the way down to that level before finding support and bouncing back higher and essentially gapping back higher on the open there. So that's bullish action in GDXJ. And of course, all of the other mining ETFs look even more bullish. as we see here in SIL, where on Thursday we got a knockdown, but it was just another test of the 200-day moving average, and actually quite bullish. Obviously, buyers came in at that support level and bid price back up, pushed price back up to here. We left this bullish doji candlestick and then continued on Friday with higher action, and actually closed either right at the 50-day moving average or just above it. So nice action in SIL. Let's look at the dollar. This is the daily chart, and we see that price finally managed to push through that resistance area last week, got up into some free air there, and then had to pull back. And of course, we can't fault any market after it's done some work like that. Deserves a break, deserves to take a rest. And of course, you know, a rest or a consolidation can look like a pullback or just a sideways movement, sideways chop as price gathers its energy. We'll see what happens, which of those occurs here. I suspect that the trend is still up in the dollar. If we look, this is the 4-hour time frame, which I don't normally show, but I wanted to look at Friday's action in particular, and this is more, to my eye, this looks like more than just a minor pullback in an uptrend. This appears more significant, like it wants to pull back. This is a deeper correction than these were. So these are just little pullbacks in an ongoing uptrend. This is something more significant. And of course, the fact that price or the dollar penetrated the median line of this shift pitchfork adds to the position that, or the premise that the dollar is going to head lower. And of course, the indicators, MACD has dropped dramatically lower from a very overbought level, and then stochastics energy plunged dramatically on Friday. So there's the dollar in the 4-hour time frame. Here it is in the weekly time frame. And so here again, it looks like obvious price target at 92. We have this horizontal support resistance level, which is coincident with the upper median line of this downward sloping shift pitchfork. So again, looks like 92 is a target here. And notice how oversold the dollar is. You know, this is the weekly time frame, so this is not a trivial, you don't get down here in a couple of days. The dollar has really been pushed lower. So it wouldn't be surprising to have a rally to the upside. And of course, if that doesn't occur, it indicates that the dollar is really weak. So we'll see what happens there. Obviously, interest rates want to head higher. In my opinion, on Friday, this market broke higher. This is a break above the upper median line of this modified shift pitchfork. And it's also a break above horizontal resistance from this previous high. Now, some people might draw this, you could easily draw that as a double top, and it may well be a double top. From a Japanese candle perspective, you could make the case that that was either a bullish or a bearish doji candlestick. In my opinion, it's bullish. And I base that on the impulsiveness of this action. So look at how, you know, we got this break above 1%, and we reached the upper median line extension of this fork, and then we pulled all the way back here to 1%. And then after testing the breakout level, that's what 1% is, that's our breakout level, we tested it, found support, and just pole vaulting higher. And even gapping higher. These are continuation, or not, I'm sorry, these are runaway gaps, bullish runaway gaps as price or yield in this case runs away to the upside without pausing. And so that's an indication of very elevated energy in this market. And again, if we look, let's go now to the weekly time frame. This thing's got a target at 1.5%. And short of outside influences, I submit that target will be reached. So we've got MACD is in bull mode with both indicators above the zero level, clearly on a buy signal for a long time now. Stochastics remain elevated. We've got the breakout above this level, a pullback, test the breakout level from above, find support, and now we're off in a new move to the upside. There's essentially no overhead resistance in this zone between current rates and 1.5%. So again, that just seems like a target that's likely to get hit. And of course, famous last word. We got the equities and we're almost done. So S&P 500 has pushed back up into this mini channel. It looks like it wants to challenge the upside of the channel and this next median line. The Dow is showing relative weakness. It has been unable to make a new all-time high. Got new all-time highs in S&P 500 and the Nasdaq. Dow's flat, so that's something to watch, is weakness in the Dow. Nasdaq is up here. It's challenging the top of both this mini channel and this median line extension of the mod shift pitchfork. And so given that the equity markets are just melting up at this point, no reason to think that the melt-up won't continue, and we'll see NASDAQ, the tech stocks, push higher next week. Brent, as we discussed last week, price, whatever market, doesn't like to sit and waffle sideways. If traders can't push price higher, they'll try to push price lower, and if they can't do either, they'll go find some other market to trade. And in the absence of any interest, price naturally falls lower. And so clearly that's not what happened. Oil broke higher last week, and that's a 6% gain. So 6% move higher in Brent Crude in a single week. Could be another indication of inflation. And folks, I started to apologize for going so long. I'm struggling between providing you value, because that's my objective, is to provide you with value, and feeling like I am monopolizing your time and spending too much time with these videos. And so if you'd like to provide some feedback along those lines, I'd love to hear it. Enjoy your week. I look forward to talking with you again. Goodbye.